For those of you who've read The Cash Machine, you know there's a ton in there about real estate. But here's what you probably don't know. The majority of what I know about real estate comes from one source, biggerpockets.com. Through its million-plus members and its amazing podcast, BiggerPockets is an absolute treasure trove of real estate information. So I can think of no better person to give us insights into the essentials of real estate investing than BiggerPockets CEO and author of the book Set for Life, Scott Trench. Welcome, Scott.
Well, thank you, Dave. Pleasure to be here, and I'm very excited to talk about my favorite subject today.
Awesome. So the financial independence world seems like it's evenly divided between two camps, the real estate camp and the index fund camp. So for someone debating which track to follow, why do you recommend real estate so strongly?
Well, first of all, you might be surprised to find this, but I am not a kind of dogmatic real estate guy that's got all of my wealth in real estate. I've invested more cash in stocks than I have into index funds specifically, in line with kind of the philosophy of a lot of the FI movement and Simple Path to Wealth and J.L. Collins, who I really admire. I also happen to invest in real estate, and I probably have a similar amount of wealth in both my stock portfolio and my real estate portfolio, while having invested maybe $75,000 cumulative dollars in real estate, and hundreds of thousands of dollars in stocks over the last 7 or 8 years.
Now, I was listening to you actually a couple of years ago, and it seemed like, looking at your path, it seems like you actually went very heavy in real estate for a while until you kind of built financial independence, and then started diversifying more into index funds once you'd already hit that point. Is that accurate?
Yeah. So the big thing for me was the idea of the house hack, right? When I was 23, 24, I'd been able to save up my first $20,000, and that I applied almost entirely to this concept of a house hack. I bought a duplex for $240,000, renovated it, moved in, had a roommate, had tenants on the other side. And that, I think, is a really, really powerful Kickstarter on the wealth building journey, because it enables me to basically live for free or live for exceptionally low cost and get a chance to ride that appreciation train. It's also incredibly leveraged, right? I'm putting down 5%. So I have a 19-time multiplier on every point of appreciation that I'm getting, right? So I get one appreciation, it's a 20-ish% ROI for every 1% appreciation. And Denver appreciated a lot more than that over the last 6 years since I've owned that property. So
do I understand this right, that you even kind of cashed out a lot of your Roth IRA in order to come up with the money for buying that house hack?
That's right. Yeah. So I had saved up about $20,000. I put about 5-ish into a Roth. I pulled that principal out. I actually ended up losing money because I think I picked some stocks in that Roth, so I didn't have any gains to worry about or those complications. And yeah, I put it all towards. I put $12,000 towards the down payment, and then sort of had a little bit left over, maybe 5-6 left over, plus I a little bit of cash flow over the next couple of months to help me pay for that. The basic repairs, the biggest of which was a plumbing overhaul in the crawl space.
So could you give us the numbers on that place? So you said that it was $240,000, and you put $12,000 down on that.
That's right. Yeah.
Was it cash flowing immediately?
Yeah. So the mortgage was about $1,550, and then I believe each side would have rented for $1,100 even. I obviously moved into one side with a roommate, and then the tenants in the other side paid $1,100 plus $50 for their 2 cats. So that doing my math, $1,700 in income from the roommate and the tenants off $550 or $1,550 in mortgage, so about $150 in cash flow. But then I've got utilities, upkeep, those types of things. So I'm breaking even at best on this property, but that's a heck of a lot better than the 6-ish plus I was spending on rent plus utilities, 600 plus I was spending on rent and utilities previous.
Absolutely. And you still own that property?
I still own that property. I'm actually doing a big remodel now. Both tenants have moved out, and we're going to redo it, and then I'm going to refinance it and pull some cash out.
What's that $240,000 property worth now, would you guess?
I don't really believe it. So it seems like the mortgage company is sending me quotes of $400,000. That seems to be on Zillow. I'm a little skeptical that it will actually come in that way. at its present state. But I think that after I put in, this is going to be like a $45,000 remodel that we're going to do to make the yard nice, upgrade both units. I have to do some work on the roof, which is not going to improve the property, but it has to be done.
Right.
Big CapEx. And I think after that, I'll be able to move the rents from 1,400 or so right now to potentially 1,800 plus. So big improvement in that. And you can work out that math, 40,000 for the $800 a month increase in rent, about a 3 or 4 year payback, hoping for higher rents to make that payback a little sooner. But I think that at that point, it will really hit a over 4 number. That would be pretty awesome.
So even if right now, even before those improvements, if you're getting $1,400 per unit, that's $2,800. And I imagine that mortgage payment is still at that $1,550 number. So
yeah, it's kind of interesting how the mortgage payment worked. So I had $1,550, but I had a PMI. So I had the mortgage insurance premium that I guess MIP,
Gotcha.
with that property. And that was about $150 a month. And then I refinanced the property in 2016, maybe out of my, maybe 2015. I'm getting my years wrong, but I refinanced out of that, and that removed the mortgage insurance premium, but I had a higher interest rate, so I only gained like $70 or $80 a month in payments. My current payments, let me get back to you on that. It's somewhere. I think it's got a 1,500, give or take $50 on that.
Awesome. So I just want to kind of illustrate those numbers. So we're looking at about a $12,000 investment that is making well over $1,000 per month in profits many years later. And you're likely going to refinance it now, maybe be able to pull out maybe $100,000 of cash off from that initial $12,000 investment. Is that right?
That's right. Yeah. And I think we say $1,000 in profit. I had very recently gotten those rents up to that level. And, now I'm doing a big remodel, which is both part to add value and part some poor management decisions that I made over the last couple of years. So we've got I wouldn't say I've earned $1,000 in profit. The cash flow, I've certainly made cash flow, but it wouldn't be a very impressive overall net cash flow if you look at the net returns to date here. I think it will be a little bit better once I complete this project and refinance. I've also got a property management company because even as I've got this title CEO of Bigger Pockets, I'm a pretty weak property manager, I think, when it all came down to it.
Well, so that can actually help everybody listening here, because I actually really want to be talking about property management and the intelligent things that people should be doing. So that maybe others can come out and profit on some of these mistakes.
Well, why don't I tell you the story of this property and my property management with it, and then maybe that will help some people. So when I first bought it, I brought in some tenants on the other side. It was a couple. And when I moved out, I brought in another couple to live in the unit that I lived in. And that second couple, great tenants, wonderful, were there for 4 years, no problems. We screened them, everything went well. The other side, I did a good job screening the tenants, followed all the instructions that I, was reading as a novice at the time. And I think I got a good couple. Well, they got divorced. Then the remaining person in the couple brought on a roommate. All was good. That roommate had 2 additional cats. So now I have 4 cats in the unit. Another year or 2 goes by, and one of the original roommate from the original divorced couple moves out. The remaining roommate brings on her boyfriend. Her boyfriend, this is where I fail. I didn't screen the moving in tenant, the new boyfriend, according to my process. I know nothing about this guy's credit, criminal, or eviction history, but I strongly suspect, frankly, that if I had, I would have found evidence to exclude him or disqualify him from renting my property. Another year goes by, and this fellow, the original, they break up, and I'm left with this fellow and his 2 cats. But so many cats have been through this property since the last remodel. It's you could definitely smell it in there when you walk through. So, anyways, and then this fellow is the one that begins causing certain behavioral issues, certain issues that that caused me to have to move on basically from the relationship there. So and I'm left now with a unit that I'm going to have to significantly remodel and some unhappy neighbors. I'll put it that way. So
Gotcha.
it's the mistake was I knew what to do. I needed to screen my tenants. I needed to follow this. I put in a procedure there. I got lazy because I didn't apply my same process to this new tenant because it was a referral from an existing good tenant. So that's where my process and management broke down.
Gotcha. It's good to be able to pinpoint those things. So sometimes we can see where we're messing up and say, oh, but come on, this person's already living there and they're going to bring in a move roommate. What am I going to do? Say no. It's hard to be very much toe the line in some of those situations.
Now, I've certainly had other properties with tenants that have had issues and those types of things, but typically I'm pretty comfortable with what I'm getting myself into up front. For example, if that tenant were an inherited tenant from a property, that's different because, what most people don't understand about real estate is, well, not most people don't understand about real estate, but a truth about real estate is nobody is selling a property that is in a wonderful location, that is in wonderful shape, that has excellent tenants at a big discount price. So you have to take on one of those things if you want to earn a little bit extra return in this business. And, so I've bought properties where I've had to deal with situations like this, but I factored that into my return profile. I wasn't factoring in a huge mess with this tenant into this property's return profile, which again, I've certainly come out a very large net winner, as you alluded to, on this property, but it's not as big as it could have been if I was a little bit more consistent with the application of my screening process.
Gotcha. So you alluded to a lot of problems that could come up with a house. You say, okay, you're not going to get the perfect location, the perfect house, the perfect tenants, the perfect price. So how does somebody who's getting involved in their very first investment, how do they weigh all of these things? With cars, it's kind of like so easy. You can open the blue book and you can see, okay, 2006 Honda with this many miles on it should be going for this amount. But real estate, like each property is so unique. Each one's in a different place. Each one's got its own issues, its own tenants, its own personalities. How does somebody make a really smart decision how to get into their first investment property?
Yeah, so let's zoom out and approach this from the very highest level, right? Because you've got your two general conflicting schools of thought in FI about investing, right? You've got real estate or stocks, and I don't know why they're always pitted against each other. Most real estate investors I know very few real estate investors on BiggerPockets who are 90% plus in real estate, 10% less in stocks. Almost everybody's got a portfolio that is diversified in a lot of ways. Even though real estate's the one we all like to talk about because we're on BiggerPockets.
Well, the real estate people think that way. The real estate people have stocks, but it doesn't go the other way around.
That's right. Yeah.
The hardcore index fund people often own zero real estate.
Mm-hmm. So here's what you got to think about. When I invest in stocks, I got to assume a long-term rate of return, and I got to assume I'm investing for the long term. This is for me. Some people have shorter time horizons. I think if you're investing for a shorter time horizon with stocks, you bring up a lot of nasty mathematical complications that arise from the volatility of the stock market. In terms of planning for a 10-year exit, for example. So, but if you assume very long-term, you got that 8, 10, 12% return, whatever camp you're in for assuming that long-term return to the stock market. You only invest in real estate requires a lot more work than stock investing. So that you should only be investing in real estate if you think that you can get a significantly greater return that's going to be meaningful to your life, right? So what are the implications of that? Well, the implications of that, there's two kind of people that are now excluded from the idea of investing in real estate. Right. One is the person who does not earn a median income, because if you don't earn a median income, it can be very difficult to save up the basic amount of money to begin entering into a real estate investment, getting credit to access loans, those types of things. And the other is the very high income earner who earns maybe over $200,000 or $250,000 a year. Why are they excluded? Because that person is probably working a job that is very, very demanding and earns a tremendous amount of money. And all they have to do to get to FI in like 5 years is not spend more than like a median American household. So investing in real estate to accelerate that by 6 months, with all that extra work is probably not that helpful, not that worthwhile a use of time. And, maybe they'd be better investing in a partnership or something more passive than, my duplex and the stories that you just heard from me, right? So you've really got this sweet spot of the upper middle class American, and they need to understand, hey, if I'm going to do that, what is that return profile going to look like? And when you invest in real estate, let's say you take an all cash property, you know you're going to get about a 3.25 or 3.5% appreciation rate long term across the US. Now, you might assume Denver is going to get a 4%, maybe 4.5. You might assume Indianapolis is going to get 2.5%. Well, whatever it is you assume for your local market, you're going to get somewhere in a pretty narrow range of appreciation. And if you're throwing darts at the wall, you're probably going to get a 4 or 5% cash on cash return if you buy a property in all in cash, right? So that's about an 8% return, which is lower than what I think you can get from the stock market if you're buying real estate all cash. So why do it? Well, you have to use leverage, right? And this is where some of the stock people get a little antsy, like, you can use leverage to buy stocks too. Well, what they typically do is they take a line of credit out on their house, which is a real estate investment, and then buy stock. Nobody is giving you a 30-year fixed rate, mortgage on a 30-year amortization schedule with a very low interest rate to buy stocks on margin and invest there. You just can't do it. You can leverage against real estate to invest in stocks, which is a whole different discussion. But the reason we use leverage in real estate is because it is much less volatile than the stock market. It's not to say it isn't volatile at all, but the 2008 housing collapse event is very rare in the history of real estate. And if you zoom out and look at the long-term pricing of real estate versus stocks, you've got a much more stable asset class in general. Again, that doesn't mean you should get comfortable, but it's just a reality of the lending world right now. When you take out a loan on real estate, you multiply your returns by the leverage ratio, right? So let's say I've got, a 20% down payment. I alluded to this earlier in my house hacking example, but if I put 20% down on a $100,000 house and that house appreciates 3% to $103,000, I have got a 15% return on my $20,000 investment. So it's because of that factor that you can begin generating bigger returns over time, that plus the cash flow. Now I'm getting college professor here on this because so let me know if I need to zoom back out. But that means that in the very first year of your purchase, you're earning a much higher return on your investment, return on equity on your current situation than you are in year 30 when you've paid it off all in cash, right? So and so the idea behind real estate is you have to buy these properties, use leverage responsibly, and hold them, and you can get very reasonably in average market conditions that 17-18% return profile while understanding you've got that risk. All right, so that's why we invest in real estate. To enter into this real estate business, I believe there's a period of self-education that is the price you pay. Again, and this self-education may be hundreds of hours, because I just alluded to a whole bunch of tenant problems. I think it takes literally between 100 and 1,000 hours of self-study to become very confident as a real estate investor and feel like you know what you're doing and have a good shot at earning these returns. That price is very worthwhile for that $50,000 to $100,000 to $150,000 a year income earner who's going to be investing for several decades. It's probably not worthwhile to that $250,000, $300,000, $500,000 a year earner, because again, all they have to do to become very wealthy is invest passively and not spend like a drunken sailor, right? So that's kind of the. I love the Navy, so please don't. A big fan of the Naval Academy, and I grew up near Annapolis, so that's intended with love.
Well, a couple questions on that.
Okay, go ahead.
First of all, you mentioned 2008. And 2008, of course, we saw housing prices absolutely plummet. But I saw a graph of rental prices, and they pretty much didn't move at all. So, if you're buying a place, you're hoping to fix it up and flip it for more money, you put a ton of money into it and the housing market crashes, you could really get hit. But those who were buying, and kind of a strategy like you had with your house hack, were renting it out and covering more than their costs, did pretty okay during that period, didn't they?
I wasn't a real estate investor in 2008. That's what I hear. Okay. I've heard a lot of other secondhand stories there, but I think generally rents tend to increase. You don't want to be on the side of the renter long term. Inflation is carrying these asset prices and rents up generally over time, which is your friend as a real estate investor. If you're leveraged against inflation, that's a good thing. And that's one of the reasons why that 17-18% return profile in average market conditions with average inflation is what I stated, and I think is a realistic target for some people to shoot for.
The other question I had there was, you talked about these high income earners. Let's say somebody who's making $250,000 a year. So I can see why investing in a single family home might be a lot of headache taking on something along those lines. But when somebody's making enough, they're an accredited investor, they can start getting into private equity deals. Isn't real estate still a really powerful avenue for them to be going on? They could still be taking advantage of the leverage. They could still be getting a lot of the tax advantages of real estate, but they don't have to have the headaches or the know-how of managing a single property.
I mean, absolutely. But now you're picking managers, which you're going to still need the same level of skill set, rather, compare,
Right.
not the same level of skill set, but you're going to need to at least have the ability to hire appropriately these professional asset managers. So yes, that absolutely, it's a good asset class for that. And there's a lot of good options out there. For bigger pockets, though, typically our folks are looking to do it yourself, to buy if not self-management, hire a property manager, but really learn the process for themselves. So that's what I mean by, investing in single family duplexes, triplexes, and quads, which is kind of our bread and butter, is really something that's for that we do. It's not exclusionary. It's just we typically see fewer of those really high income earners applying themselves to this.
So how can somebody tell if something is a good property, if the numbers work out, if it makes sense for them to be investing in?
All right, great. I'll try to not do college professor this time, but I'll give a 3-minute response still there. So we've got 5 things we got to figure out, right? We got to figure out which market to invest in. We got to figure out which city or neighborhood within that market to invest in. We've got to figure out what property, I guess, whether to invest locally or out of state, basically, right? And then we've got to figure out whether my deal is a good one relative to my local area. And then I've got to be able to operate to market conditions, right? So this is where a lot of people get hung up right away on, my market's terrible for investing, I can't do it. Right. Well, one of my colleagues, Dave Meyer, put together a really good study here analyzing cash flow and appreciation profiles across the country. And they're almost linearly inversely related. What that means is if you want more cash flow, you're going to go into a market over the last 10 years. The markets that produce good cash flow typically produce much worse appreciation. And the markets that produce better appreciation typically produced much less cash flow. So that mythical market where you can get both does not appear to exist. There are certainly, in this big bubble of scatter plot points, some markets that are a little more on the edge of both cash flow and appreciation than others. But when I look at Denver, Colorado, people think Denver is very overpriced. We are right smack dab in the middle of this big blob of the U.S. economy for overall cash flow. We are not a bad cash flow market. We are an average cash flow market with great appreciation. Right. So that means I've got a great market. So I've got 2 choices there. I can fight the local dynamics and destroy value. I think it's much more difficult to invest successfully out of state or out of market than it is locally. I can meet people face to face. I can take care of some problems myself. I get learning opportunities that are not available to me as a completely remote landlord, whatever. If I'm in San Diego or San Francisco, California, I truly am in that 0%, ish cash on cash return profile market. And maybe I need to go out of state. But I think that's the first thing, is take a quick look and do a sanity check. Am I really in a bad market? And do I really want to fight my local market dynamics in order to go after an Indianapolis investment? Nothing against Indianapolis, but Indianapolis may not have produced much appreciation, and the combination of return you get over the next 10 years may not be that much better than your local market, frankly. Anyways, once I've decided on my local market, I got to zoom in on those neighborhoods and figure out where that appreciation rate is. Easiest way to go, or where the cash flow and appreciation potential is. The easiest way to do that, I think, is to talk to local real estate agents and local investors. Meet with 5 or 10, and you're on the right track once you can distinguish who you think knows what they're talking about and who's getting lucky. So that's kind of a good benchmark that comes along with the podcasts, books, and maybe a bunch of these meetings. From there, we got to pick. I've narrowed in. I picked a market, a neighborhood. My approach here is I will look at. Maybe I picked 3 neighborhoods that I think are high potential. I will go on the MLS. You can do this with an agent. I happen to be an agent, so I got my license specifically so I could do this for myself. But I'll look and I'll say, show me. I'm going to look at all the properties that have sold in the last 180 days that reasonably fit my criteria in that neighborhood. And then I'll say, okay, great. There are 180 of these, right? I'm going to narrow that down until I get to 5 to 10, the 5 to 10 best deals that have sold in the last 180 days. And if I can look at those and honestly say, I would have, barring something, a nasty surprise in the closing process that was a deal breaker, I would have bought all of these deals. I know I'm in a winter market. And I know that given the fact that there are 10 in the last 180 days, on average, once every 10 days, maybe a little bit less frequently, a property like that is going to come online. And that means that when that happens, that's a good deal. I've defined my good deal in crystal clear terms. This is a very simple, I think, repeatable approach people can take with a few hours. Once that good deal comes on the market, now it's time to pounce. I'm not making an instant rash decision. I'm making a very cold, calculated decision well in advance. I'm just going to react once that comes online instantaneously. I've got I'm ready to offer. My lender is ready to provide me with a pre-approval for a property of that type. Usually that I have a good relationship with my lender, so I can get that pre-approval that same night and send it over along with my offer. I can make an as-is offer, all those types of things. And then from there, I just need to know what rents are and make sure I'm managing and operating the property to its full rent potential.
So let's talk about that. What type of rent do you need to get back on a property to make it worth the investment?
It depends, right? But I'll be more specific than that. Let's say that I'm looking at a neighborhood in Denver, Colorado that I like. On one edge of the neighborhood, I'm right next to a really nice park. On the other edge of the neighborhood, I'm next to the highway, right? The highway is a unchangeable. Actually, this is not true. In Denver, we're doing this absurd project to bury our major highway underground to build a park over it, all to make my first duplex more valuable, I guess. But I would vote against the project, but I'll take the appreciation. Anyways, moving away from politics, in that neighborhood, if I'm near the highway, I want a property that has more relative cash flow. If I'm on the other edge of the property, the neighborhood, I want a property with, I'll be willing to accept less relative cash flow. What does that look like? Maybe I'll accept a 3 or 4% cash on cash return in the area of town, in that part of the neighborhood that I think has really high potential, but I'll need a 6 or 7 or 8% cash on cash return profile to go in that area that's less desirable. So it's a sliding scale for me, frankly, based on the relative prospects of that location. And that this should be a good thing. If you're listening to this, there is no way to put what I just described into an algorithm or a spreadsheet. And if there were, Wall Street would dominate this marketplace and you would not be able to compete. So at the end of the day, the fact that I have to describe it like that and based on my local knowledge of the market should be very encouraging. That's where the returns are. This market is much more inefficient than the stock market. So that means that there's opportunities there if you self-study, read, educate, network, and know your hyper-local market in particular.
So when people use a rule of thumb like the 1% rule, you'd kind of look at that as an oversimplification.
Oh, I hate the 1% rule. Yeah, I think, look, the 1% rule is.
Let's just explain it for anyone who doesn't know.
The 1% rule says if my property rent is worth $100,000, or I'm going to buy it for $100,000, I need to produce at least $1,000 in rent in order for that to be worthwhile. I have not seen a 1% rule property that wasn't a meth house in Denver, Colorado in the last 5 years. So that is not a realistic expectation. And to say that you can't produce cash flow on the 1% rule is completely excluding most, I think, higher priced markets in this country. Cash flow is a function of rent minus your vacancy allowance, which is an offset to your rent, right? Minus your CapEx reserve, your maintenance expenses, any utilities, your financing costs, taxes, insurance, and then property management fees, right? So that is cash flow. And Denver, Colorado, we have very low property taxes. We have very relative low insurance rates. So you can cash flow. Those are really the two big offsets. Maintaining a house in Denver is no more expensive than maintaining a house in Memphis, Tennessee, a popular quote unquote cash flow market, right? So, the CapEx that I spend on a property in Denver is no different you transplant my duplex to Memphis, Tennessee, it does not all of a sudden cost 3 times as less to replace the roof or buy an appliance, right? I could buy it on Amazon for the exact same price. So those are fixed dollar amounts that do not scale with the much higher rents that I command, and the higher property value. So you have to understand your cash flow in terms of those components, not in terms of the 1% rule. But where that becomes very useful is I know, like, hey, I'm really looking at like a 0.8% rule in Denver, where I'll get $800 for every 100,000 in purchase value in rent. That's a useful mechanism for me because I can tell where the relative cash flow is going to be instantaneously looking at a deal, within a few seconds. Like, hey, this deal, I'm getting $850 per $100,000 in purchase price. This one I'm getting $750. The relatively better cash flow is obviously deal A. So it's useful as a construct in comparing properties in your local market. But if you're living your life by the 1% rule, it says to me that you haven't completed that hurdle of several hundred hours of self-education in real estate to get familiar with the process here.
So you mentioned the only place you're going to get that fits the 1% rule in Denver is a meth house. That's one of the things I've heard is that, the more dangerous the neighborhood you go into what's called, a D neighborhood, your returns might be better, your cash flow might be better than, say, an A neighborhood, which kind of a nice suburb with, the big fancy lawns and people who are making a lot of money. So at what point should somebody be factoring that in? Like, for somebody who's getting in for their first investment, what type of neighborhood should they be aiming for? Will it be that much easier for them in the A, B neighborhoods? Should they be avoiding something that a bit more high return, but might be more specialized market?
Look, I think it's going to the individual investor is going to be comfortable with what the individual investor is going to be comfortable with, right? Some people make money in high-end condos, which I don't understand. Some people make money in, Class D neighborhoods that have very high crime rates, right? Some people make money in kind of that like I'm in this like B to B plus neighborhood that's kind of increasing in value very rapidly, and I make money there, right? So I think everyone can make money in all these different markets. And if you listen to the Bigger Pockets podcast, you'll hear, hundreds of examples of people succeeding in completely contradictory ways in this market, which is, I think, a wonderful thing. I think that when you hear people talking about the Class D neighborhood, some of these folks make a great living, and this is a very successful outcome for them. But I think that the appeal of it sometimes is too hyper focused on the cash flow numbers and doesn't really take into account the other stuff that you have to be, frankly, speculating a little bit for, right? Returns in real estate come from both appreciation and cash flow. We like to use amortization and tax benefits as well as wealth builders, but really those are the two factors that you are investing for, is that appreciation and cash flow. And if you ignore appreciation, that's foolish, in my opinion. If you ignore that as a calculation, if you ignore that funny feeling in your stomach, like, hey, I've talked to a lot of people and this part of town seems like it's going to boom, but I'm going to invest over here in the war zone for the extra, 10% cash flow. That's I think to your disadvantage to a certain degree. I think it's an incomplete analysis of your local market. So I analyze for both, and I apply that tool there, and I think that has proven to be very worthwhile to me over the last 5 or 6 years, and time will only tell if that continues to be there. Now, one caveat there. I will not say that I invest foregoing cash flow. I will not have a zero or negative cash flow on a property, but I will take less positive cash flow in order for more appreciation potential.
I think that's an important distinction, because if you're being so leveraged, if you have negative cash flow and you're super leveraged, you might be in a real jam. Whereas if your cash flow is positive, even if the market goes down, you really are able to have the ability to ride it out until it comes back. Yeah.
Also, I want to clarify, war zone is an inappropriate term, which we're trying to eliminate from the vocabulary. So I apologize for that. A neighborhood that has a higher crime rate or has less appreciation potential in your assessment. Those types of things are what we want to ask those hard questions around that.
So I'm definitely getting the sense that there's a certain amount of luck that plays into real estate investments. But as I heard you say earlier, the harder you work, the luckier you tend to get.
Yeah, I think that's right. I think there's a speculative component to this that really, you know, that really is a factor. But I will also say that the farther you zoom out, the less lucky that appears to be. What I mean by that is, maybe you say, is Denver and this particular market that I invested in that duplex in, how's that going to do over the next year? How's it going to do over the next 3 years? How's it going to do over the next 5? Right? All of those are really uncertain. So many things can impact those. But how's it going to do over the next 30 years? That seems a little more certain to me. I can feel a little more comfortable about the prospects of this particular market over a very long, decades long horizon and its potential. And that is going to be between 2 and 4%. And I'm betting personally with my money that's going to be closer in that 4, maybe even upwards of 4% in a long-term appreciation rates. So while luck is certainly a factor in the short run, I think that a lot of reasonable people can begin to narrow in on those ranges for long-term appreciation in a lot of their local markets as they zoom out and think over in terms of decades rather than in terms of months, years, or even half decades.
All right, fantastic. So if people want to learn more from you, where can they go? Where can they find you?
You can find me at Bigger Pockets. You just type in search bar Scott Trench, and you can network with me there. You can email me at scott@biggerpockets.com. I've got a Instagram at Scott_Trench. We've got the Bigger Pockets Money podcast. Those are some of the big ways.
I want to add one to that, which is your book, Set for Life.
Oh, thank you.
Like I told you before we went on, I only discovered it like a year or so into doing my research for the Cash Machine. And when I read this book, I'm like, wow, had I had this at the beginning, this would have saved me like a ton of time. It lays out so many of the components of financial independence, and I think is a great read.
Great. Well, I appreciate the plug. Yeah, I'm a big fan of that book too.
Thank you so much, Scott. I appreciate it.
Thank you.